So I would like to welcome all of you to the world of accounting, financial accounting to be precise. In this particular session, we're going to show you one of the most important steps in financial accounting. This particular session is going to focus on the basic accounting equation. And it would be suitable for students who do not have accounting background or who need a reminder of the basic introductory concepts of financial accounting. And I have been teaching financial accounting to beginners for a very long time. And I can safely say that I know the tricks that you as an accounting student should have in order to succeed in the module. All right. So for most of you, if you are beginning, you struggle a lot. Everything is new. Everything looks cryptic, and we will show you that if you follow the steps that we're going to demonstrate to you, accounting should be very easy. Like I said to you, I've been teaching accounting for a very long time, especially to students without accounting background. And the students who get distinctions in my classes, most of them are those without accounting background. But then there's always this negative perspective that I don't have accounting background. That's why I struggle, or I will not make it because I do not have accounting background. But that's never the reason why you not gonna make it. Because what you need in order to succeed in accounting is that you need to, so these are some of the tricks that you might need. So you need to be able to understand English. And that some students find it funny when we say that you need to be able to understand English. But sometimes it's an issue of not understanding what the question is talking about. So if you can understand English, accounting for you is going to be an instruction given to you in English. It's like you do not know a particular city in Australia or wherever in the world, right? But if you follow instructions, they say 10 right, 10 left, go straight. You should be able to reach your destination because you can understand the mode of communication in which the language that is being used to give you the instruction. So the instruction is going to be in English. And if you are good with English, you understand English, then you should be fine. Otherwise, you do not do well because you don't understand English. That's not a joke, but that's a motivation for you to say, if you can understand an instruction, what's the reason that you won't know what to do because you have never done it before? But you being given that particular instruction, 10 right, you never turned right before in that particular city. But the instruction says 10 right. So you turn right and you reach your destination. So we're going to give you instruction that is going to guide you so that you will be successful. So that's one of the things that you need to do. Then you need to do to be able to do to have basic logic. All right, because I always tell students that most of the questions that you come across are questions of logic. The actual accounting, you do it at third level and fourth level when you're doing your honors accounting or your CTA. Then you do the actual accounting. Now that's no longer English, that's no longer logic. You really need to have a knowledge, in-depth knowledge of the accounting. But for introductory levels, you need a lot of logic to make sense. For example, how do you make sense? You see the people that selling on the street, they make sense, because they know that they buy this for so much, then they should be able to sell this for so much and make a gain. And that gain includes their transport and other expenditure, So if you have that logical approach to things, they should make sense. For example, how do you determine profit? In an accounting environment, all you need is the income, right? minus your expenses. You don't quite need to have accounting background before that makes sense to you. Because like I said to you, the vendors in the street have that logic. They don't have the technical accounting procedures. They don't follow the technical accounting procedures to determine income and expenditure, but they have the logic of how things should work. And then number 3, you need the motivation. All right. So you need to be properly motivated. And that means you could be practicing every day. You could get somebody to practice with. You could join our tutorials or anybody's tutorials, if you can. Or you can use high school students who are neighbors to you. Can you help me with this? If they're studying accounting, they will probably understand and be able to assist you. Practice every day. That's the rules in accounting. Brilliant. So we are Topcrest online tutorials. So what we do is that although we offer private tutorials, extra classes to students who are interested, we also post a very useful resources on YouTube. All right. And so if you like to, you can log in there. You can look at some of our postings. They're definitely going to help you. Or if you want, you can contact us and join some of our free groups. All right. So these are our contact details. Now let us talk about accounting. In accounting, we have something that we refer to as accounts. All right. That is accounting, and then we have accounts. So this is how an account works. You have an account at Edgar's. All right, you have an account at Woolworths. All right. Okay. In other words, you're gonna buy on credit. Okay. And Woolworths is gonna keep a record of your transactions. If you buy more on credit, they're gonna add more of what you owe to them. If you make a payment, they deduct. You have a new balance. If you make a payment, they deduct. So Edgar's is very much interested in you as an individual. So they give you an account number so they can track you to say how much have you bought, how much have you paid, so that they can know. All right. But now Edgar's is dealing with you as an individual customer. Right. So they give you as an individual an account or an account number or account name. But in accounting, that's basically exactly what we do. We want to track some expenditure. We want to track what's going on in this particular item. For example, we could be interested in knowing how much electricity do we use in a year? Or in other words, how much does the electricity we use in a year cost us, the cost of the electricity? So every month we open an electricity account, right? And every month we record the monthly charge, January charge, February charge, March, and all the months. So at the end of the year, we get a total of the annual expenditure on electricity. So we open an account for electricity consumption because we are interested in following up on having an accurate record of what's going on with our electricity. So whatever expenditure or whatever transaction that we are interested in, we open an account, and everything that happens that affects that account, in other words, all transactions affecting that account are going to be recorded in that particular account. So we could be interested, for example, in knowing, like the example that I gave you, right? I gave you an example of electricity, but that's not the only thing we are interested in. We could be interested in let's say we are Pick and Pay, right? So we could be interested in how much we spend in our salaries and wages to our staff. So we keep an account called salaries and wages. So each time we get charged for their work, we're going to record it there. All salaries every month, we're going to record them there. All expenses for staff, that is in form of salary, we're going to record that. We're going to record them in that particular salaries and wages account. As Pick and Pay, we're also interested in the rentals we pay because we're there at mall, we're renting. So we need to know how much rentals we paid. Right? So we're going to open a rental expense account. So each time we pay rent, we're going to record there. so that at the end of the year, we have a total amount of how much rent did we pay. So we can have a lot of things we're interested in. As Pick and Pay, we're interested in, for example, our marketing expenses. We're interested in our IT expenses because we need technology and it's going to come at an expense. We're interested in our delivery costs because then we have to move things from the warehouse to the shops. So we open an account for everything that we have an interest in. We're going to buy things from Tiger Brands Foods. We're going to buy food from Pioneer Foods. All right. So all those things that we buy to sell, we need to know how much, what is the cost of all those things that we bought this year. All right. And when we sell, we record all our sales so we can know from that sales account how much sales did we make during the year. So that's basically the accounts we're talking about. Now, if you look at this example, accounts in accounting are going to be categorized as an account under assets, an account under equity, as well as an account under liabilities. All right. So assets are those resources that we use. And we will definitely, we will understand that better by the examples we will give you. So assets, we have what is referred to as current assets and non-current assets. I'm not going to give you technical definitions of what a current asset is, but a current asset is those resources that we use on a daily basis and we finish them, for a short time. Whereas non-current assets are gonna stay with us for a period longer than 1 year. This is a generalized description. So what I'm going to do is that I'm going to give you examples of accounts that fall under current assets. So in your assessments, right, they're going to, for sometimes they're going to give you a transaction that happened. They're going to explain to you what happened. As a student, you should be able to pick which accounts have been affected. For example, if Pick and Pay pays salaries, right, to employees, right, you should be able to pick from that statement that this money came out of the bank account. So because we are interested in tracking the bank account to know how much money is going in and going out, we open a bank account. So we have to record that in the bank account, but it was for salaries and wages, right? So we also want to know at the end of the year how much salaries and wages we paid. So we record the same amount under salaries and wages, we record the same amount again under bank. So you can pick the accounts affected. So if you know these accounts, it's a lot easier for you to pick which account has been affected. So I can tell you that the single most important step is to understand these accounts and their categories. So if we say petty cash, what is that petty cash? And which category does it fall under? Right, so that's what we're going to do now. I'm going to just give you a brief explanation of what each account is about, so that if you read, you'll be able to pick up what's happening. So petty cash is that little cash that we keep at work, so that maybe there's a woman that is selling brooms. You don't have to do an EFT. You don't have to log in into the company account, bank account, and then do a transfer. You can just, sign. The finance manager or the accountant can quickly sign, and then you withdraw from the box 300 rand and you pay the broom, and that's it. So that's petty cash. It's petty. It's not a lot. It's small. Then trading inventory is also a current asset. Trading inventory refers to those goods that we buy for resale. So if you go to Pick and Pay, all that which you see displayed in the shelves is the trading inventory. If you go to another shop, whatever they're selling, whether it's laptops, it's a trading inventory. If you go to BMW dealership, right, and you see a lot of BMWs that have been displayed there, that is trading inventory. Trading inventory, or simply inventory, is those goods that we bought for resale. They're not necessarily goods that we bought for use. We don't want to use them. We bought them so that we can sell them. That's inventory. So when you go through a transaction, you should be able to know if we buy something, what's the purpose? Right? Because if we buy to use it, then it's not going to be inventory. But if we buy to sell, then that's going to be trading inventory. Then we have consumable stores on hand. Now, consumable stores on hand, these are the things that I'll give you an example of consumable stores, right? Like at Pick and Pay, like KFC, right? They have those cups, you know. So if you want to get some milkshake or some whatever they sell there, or if you want to buy KFC, right, that chicken, they have the package that they give you. So they keep it there so that if you want, they then can put some the goods that you've ordered and they give them to you. All right. So those are consumable stores on hand. Okay. So other consumable stores on hand, you can think in terms of stationery that you use at work. All right. So if you're a big company, the company is gonna buy you what? Stationery, I don't know, whatever it is for stationery. It could be pens, it could be whatever you use at work, your books, writing pads, and whatever. Those are consumables on hand. Then, so those are current assets as well. All right. All right. So we said that consumables on hand, that is those that we haven't used, because we're gonna buy like 10,000 during the year, and we use 8,000 of that. So to the 2,000 remaining is what we refer to as consumables on hand. But the other 8,000 that has been used up is going to be an expense. Brilliant. Now we come to debtors or trade receivables. So trade receivables refers to our customers. We sell on credit to them and they haven't paid. So the total amount owing is called trade receivables. We are supposed to receive that from our debtors. Okay, so you can also refer to them as accounts receivable, or if you are doing law, then you can refer to them as clients control. Then accrued income. So if I can just go back to trade receivables. Trade receivables refers to customers who haven't paid. But these customers are for our business, all right? So we go to, let's say we go to a company that sells on credit. All right, so then these goods that it sells that haven't been paid for are going to constitute trade receivables. Trade receivables are going to be what the company's business is, all right? Because you can be owed by a lot of people, but we are talking about customers who owe us for our business. Then we also have what we refer to as accrued income. This is a side hustle as opposed to trade receivables. Accrued income is that other income. For example, we might have extra space in our warehouse, and then there's a smaller guy who comes and says, guys, can I use the space? And he's supposed to pay rent. Now, renting out space is not our main business. So if the guy hasn't paid us, it's not going to be trade receivables. It's going to be accrued income. Yes, he owes us, but that's not our main business. So accrued income could be your side hustle, your smaller source of income, not the main thing. For example, it could be your interest. Like if you do a deposit with ABSA for 5 years, maybe for a year, and ABSA is supposed to give you interest on that, but they haven't yet. It's called accrued income. All right. Then prepaid expenses is also a current asset. So we're gonna pay in advance. Let's say it's our rent. Then our year ends on in December, and then we pay rent for January, February, March in advance. We haven't used the facilities yet. We haven't used the facilities yet, but we're paying in advance. So the portion paid in advance is called prepaid expenses. It's going to be an asset. So do you know why I'm explaining these things to you? I want you to be able to pick up each time there is an accrued income. You should be able to read and see if that's the main business. If it is a main business and a customer owes, you need to pick that's trade receivables. But if it is a side hustle, like they have some extra source of income, but they haven't been paid, that's accrued income. And of course, we have bank is an asset if it is a positive balance or a debit balance. All right. So bank is not just going to be an asset all the time. There is a condition. So bank is going to be an asset if it is positive or debit balance. Right. So cash float is the same thing as paid cash. Then a law library, I don't know what it is, but I think it's access to cases that lawyers use. So if you have a law library, that's a non-current asset. So investments in general, if you make an investment, all right, in another company or on the shares, we generalize at this level to say that's a non-current asset. So if a company takes some extra money and deposits 500,000 in an investment in Absa Bank, so that's going to be an investment. Of course, not all investments are going to be non-current, but I said for now, we're going to make that assumption. Land is, of course, land. We have buildings and there's a land space that is occupied. That's a non-current asset. Buildings is obvious. Now, this land is land for use. Did you know that? Because if we hold land for sale, and that's our business, it's going to be trading inventory, right? But if we want to use it, then it becomes a non-current asset. But if we hold buildings, let's say we are a construction company or real estate developer, I think, and so there's buildings that we build and then we have to sell to people. They're never going to be called buildings. They're going to be called inventory because we build them with a specific intention of selling. So that's inventory. Whereas if we want to use them as our offices, as our warehouses, they're going to be called buildings. The same applies to vehicles. We want to use them. If we want to sell, if we are in a business of selling vehicles and we buy these vehicles specifically for sale, they're going to be trading inventory, right? But those which we buy for use, even though we are a motor vehicle dealer, a motor car dealer, and we buy some vehicles for use, they're going to be vehicles under non-current assets. But if we buy, so let's say we buy 10 vehicles, 2 for use, so those 2 are going to be vehicles under non-current assets. And then the other 8 are going to be trading inventory under current assets. So the same applies to furniture, right? Equipment, machinery, and fixed deposit, right? So I think that follows. So those are assets. So what you need to know, you need to be able to identify these are all accounts under assets. And some of them can be classified as current and non-current. You need to know this because the question is going to ask you to, it's going to give you a list, right? And after giving you a list, they will perhaps ask you to determine the non-current assets, determine the current assets, or determine total assets. So you should be able to pick those things. And like I said, this is the most important step that you're going to take to understand what each account refers to and the category it belongs to. So this basic accounting equation, which says assets is equal to equity plus liabilities, is an equation that should balance. All right. And therefore, you need to be able to know what constitutes assets, what constitutes equity and liabilities. So under equity, we have those items that affect equity directly. So this is drawings and capital. So drawings and capital affect equity directly, whereas expenses and income affect equity indirectly. All right. Later on, we'll explain to you how they actually do affect that. But for a beginning, I think that should be sufficient, right? So expenses, if you want to speak, if you want to think of expenses, like I said, one of the things you need to know in accounting is It's English. If we ask what is drawings, that's an English word, right? That's not an accounting word. That's an English word. Drawings means we are withdrawing something. So this is when the owner takes something from the company for personal use. That is very important. All right. So there's a difference between a business and its owner. All right. So if the owner takes cash from the business to pay his own rent at home, where he stays with his family, that's a drawings. But if the business has also its own premises and the business takes money to pay the rent for its own offices, then that's not drawings. That's called rental expense for the business, because it's the business that is benefiting. But if the owner takes something for personal benefit, that's drawings. So when you read through a statement, you must be able to see if the owner did that for personal benefit. Then capital is anything that the owner contributes. Could be a laptop, could be a vehicle, could be cash. It could be paying something on behalf of the company by his own personal money. Because remember, for accounting purposes, the owner has his own bank account, right? And the business has its own bank account. So if the owner would pay, let's say the business has to pay telecom, right? And the owner decides to use his own money to pay telecom. That's an injection into the business. So that's capital contribution. Capital can be contributed in many ways. That's as long as the owner is not paid back, that's going to be capital. But if the owner is paid back, that's drawings. So we now go to expenses. And like I said, expenses reduce income. No. So they don't reduce income. Expenses reduce equity. All right. So an expense, I'm not going to waste time there, right? Because that's English. Expenditure, those things that you spend money on so that you can run the business. Of course, you're going to buy things from suppliers. All right. So that's cost of sales. You're going to pay people, that's salaries, or you're going to use stationery. All right. Those things that you buy like staplers, like punchers, like whatever it is that you use at the business. Then if you sell something, a non-current asset, any of those, and you make a loss, then that's an expense. Rental expenses, advertising expenses, those are straightforward, right? Credit losses is when you give some people money, goods rather, on credit, or services, because it's not always goods. Sometimes it's goods, sometimes it's services. And they're supposed to pay you, but then they disappear. They don't pay anymore. So whoever can't pay is going to be an expense. Credit losses. We pay for insurance, right? We pay for bank charges. We pay for repairs and maintenance of whatever being repaired. Remember, it's buildings, water and electricity. So those are expenses, right? And we're gonna open an account for each expense so that we can track its performance. What's happening with water and electricity? What's happening with our repairs and maintenance? All right, so we're gonna open an account, and each time we record some extra repairs and maintenance, that expense is gonna increase. And when that expense increases, the equity is gonna decrease. All right. So we're gonna teach you more when we come to the double entry system. All right. For now, we just are classifying accounts, but we'll come to the double entry system for financial accounting, right? So other expenses include your depreciation. That is when your non-current assets are losing value. All right. So that loss of value is called depreciation. For now, that's what we say. And then we have interest expense. Maybe we borrowed or we bought something on, we bought land on mortgage, right? So we have to pay that interest to the bank. Then income is obviously income, right? Like we said, we need to know English. So income is income that increases equity. You have your sales, the things that if you sell, you record all your sales you make under sales. If you are not a selling business, you could be a lawyer, you don't sell, you offer services. You could be a plumber, you could be an electrician. So then each time you offer a service, you charge a fee. You're going to record that under services rendered or fees earned. All right, like this particular. Or interest income if ABSA gives us interest, or we sell something on and we make a profit, any of these non-current assets. All right. Maybe we act on behalf of other people and we get a commission, we are let's say we are what? A garage, like Shell garage, all right, engine garage. Then some people say, look, can we put our stuff in your garage, right? So for each item that is bought, we're gonna give you 2%. So we're getting commission for that. Credit losses recovered. Those guys we thought are not gonna pay now decide to pay. So rent income. So you can think in any circumstance, these are not the only accounts that we have, right? There could be a lot, but each scenario that you deal with should guide you into knowing which account could it be. All right, so there's a lot plenty, but this is a general guide. Then we come to liabilities. So liabilities refer to what we owe, which we should pay or pay back the money. Right, we have to pay people their money. Equity is also referred to as net asset value or owner's equity. Right. So that's the same thing. But liabilities is what we have to pay. We owe people. So we also have current and non-current liabilities. So generally, current liabilities, we have to pay them this year or within a year. No, not this year, but within 12 months, right? Now, this is a very general description, definition. Non-current, we have to pay after 12 months. All right. So we have what we refer to as creditors or trade payables. So trade payables, right, refers to not just any people we owe, but people we owe for business, in the sense that we buy from them the things we want to sell. Okay. So if we owe other people, like we haven't paid people salaries, those are not trade payables. That is accrued expenses. Any other expenses we haven't paid are called accrued expenses. We haven't paid water and electricity, that's accrued expenses. We haven't paid telephone, that's accrued expense. But we haven't paid those people who supply us with the goods that we want to sell. Those are creditors or trade payables. All right. And a bank overdraft, I think you all know, right? You allowed to withdraw beyond your balance, and then the balance goes into negative. So that's why we say a positive bank balance is an asset, but a negative bank balance is a bank overdraft. It's a current liability. Then sometimes we have a current portion of long-term borrowings where we have to pay some portion of the long-term loan within the next 12 months. We can also have short-term loans, right? For 6 months, we agree. So that's current liability. Then we also have income received in advance. So the income received in advance is more like trust creditors, right? It's more like trust creditors, except that trust creditors, we specify them because they are used in a law environment. But income received in advance is when people pay you in advance. Let's say we have a big warehouse, and right, then there is a guy who asked to use the extra space, and then he says, okay guys, I'm paying rent for January, but I'm also paying for February and March and April, and it's only in January. So he pays that rent in January in advance to cover also February and March and April. So that's income received in advance. And your trust creditors in a law environment, you're gonna save clients, all right, but sometimes they have to pay to make payment, and the case is not yet finished. They can give you the money, so that hold this money, so that when the case is finished, you can now take it. So because the case is not yet finished, it's income received in advance, but it's also called trust creditors. Then we have long-term loans, mortgage, and debentures as non-current assets. Non-current liabilities, my apology. So now, how the examiners examine you? Like I said, this is the most important. This is the backbone for you to passing the module. This is the background. You will need to understand a scenario given to you, and you need to know which accounts are affected, as well as the categories under which those accounts belong to. Now I'm going to give you a quick exercise. So what you can do if you're having this on your, if you're watching this from YouTube, then what you can do, you can have a look at this item, and then you can stop the video, right? So you can stop the video, and then what we want you to do is to know this is the item or account. Then you must be able to identify which category it belongs to. All right. So that's what we want you to do. We want you to identify this, so you can stop the video and try to identify which category each of these belongs to. Then after stopping the video for whatever amount of time, then we're gonna discuss together on the next slide to determine which category each belongs to. So that's just a simple exercise. But like I said to you, if you're a diligent student, you need to take this very seriously, because that's the backbone, that's the background, that's the foundation of you understanding financial accounting. All right, once done, let's do together the final answer. So this is the account. So capital is going to fall under equity. Salaries and wages is going to fall under expense. And remember, expenses also fall under equity. All right. Interest on bank overdraft, we're being charged. So that's an expense. An expense also falls under equity. We have demonstrated that to you, right? Remember that under the equity account consists of 4 categories. Right? For assets, it's current and non-current. For liabilities, it's current and non-current. It's only 2 categories. But for equity, we have drawings, capital, expenses, and income. All right. And these are recognized directly. These affect equity directly, right? But these affect equity indirectly through profit or loss. Whether we have made a profit or loss, then that profit or loss will then go and affect the equity. So it's indirect. Rent income. So this is income received in rent income deposit received, right? So somebody has paid a deposit, but we're just holding that deposit. It's in trust. It's not our money. It's current liability. We're supposed to pay it back. All right. So drawings fall under equity directly. Trade payables is also creditors. That's a current liability. Remember, those people from where we buy on account, we haven't paid them, but we are buying things to sell. In other words, we're buying inventory from them, not just anything that we owe. We owe them for the inventory. They are called creditors. Dividends received, it's straightforward, that's income. If we make profit on the sale of non-current assets, that's also income. Petty cash, we demonstrated to you, that's current asset. Investments, we said for now, we're going to classify it as non-current. And their depreciation is an expense. Credit losses is an expense. Income received in advance is the same thing as rent income deposit. So that's also the same thing for you as trust creditors. It's not exactly the same thing, but that's the same principle. That's a current liability. Accrued income. Remember, this is our income from a side hustle. It's not the same thing as trade receivables. Trade receivables is for our customers. We sell to them on credit. But this is a side hustle. Someone just owes us some money. That's a current asset. So water and electricity deposit, like we deposit for water and electricity, maybe to the municipality or wherever, that's going to be our current asset. Accrued expenses, that's a current liability. Remember, accrued expenses, we said they differ from trade payables, right? Because trade payables is for inventory, but accrued expenses, we haven't paid other services. We haven't paid our water, we haven't paid our electricity, other expenses that we owe. Then a mortgage, of course, it's supposed to be non-current liability. So how did you do in this? Did you get it right? So this was just a mini exercise. So we actually do offer classes if you are interested. All right. If you're not interested, it's fine. We hope this will help you, but you can still join our groups. There are thousands of students there, and you can interact with others. There are also tutors, plenty tutors. So if you want to join those free groups, you can contact us here. You also, if you want to join class, you can contact there and say, guys, I need to join class for this particular module. Then the admins or the reception people will help you to join the correct group. So in that group, you can choose to stay there without pay because it's free. Or if you want to join the paying group for extra classes, then you can join. Because for our extra classes now, for example, if you would join our classes, what we do is that we're going to give you additional exercises. Then we go through those exercises with you. We have extra sessions with you, not just these ones that are recorded on YouTube. And we hope you guys are going to find this very productive. So keep on remembering to work hard, keep on participating, keep on asking questions. If you need tutorials, you are welcome. For any module, you're welcome to come and talk to us. So always check our recordings on YouTube for any module. If there's a module that is missing and you think you could do with a recording or two, you can come to us and tell us, guys, do you have any recording in this? Okay. Then perhaps one of our tutors will prepare a recording for you. But good luck with your studies. All right, remain focused, make time for daily practice, and all the best.